Cool, Abdul. Great to see you here. Are we ready to roll? Good day, Rocky. All right. I think it's time. Excellent. Let's do it. Welcome to the webinar today. We're going to talk about how to know whether your trading system is going to work. And the reason why this is such a critical topic is because a lot of traders fall into some traps along the way. What I'd like to do is to share with you today, and welcome to those of you watching the recording. I know most of you are actually watching the recording, not here live, but it's great to have all of you here live. The reason why this is so critical is because there are a series of mistakes that I and just about every other trader out there make on their way jumping through these hoops to getting to that spot of consistent profitability. And so what I want to do is share with you a process, a checklist, if you will, that you can use to actually identify whether or not you're on your way toward consistent profits. Now, so just to introduce myself, my name is Walter Peters, and I wrote the book called Naked Forex. So I like to use simple and repeatable price patterns off of support and resistance levels. That's essentially how I trade in a nutshell. And I know a lot of you, of course, I know you and your students and all that, and you're part of our community and in the private forum and all that, and that's great. But some of you are new, and some of you haven't ever seen anything like this before, so just wanted to do a quick introduction. So let's get started. Rocky said, I badly needed this, thanks. Awesome, Rocky. Okay, so let's go over it because we should identify kind of your sticking point and how to get around this. And if you're new to trading, oh my, I would have saved myself 4.5 years of pain and suffering if I had this webinar when I first got started, believe me. But that's water under the bridge now. So let's just get started and roll into it. And then, of course, at the end of the webinar, I'm happy to go over the live charts, show you the charts that I'm trading and watching like a hawk and all that, and we'll see where we're at with that, okay? So, of course, I'm going to apply my perspective, which is naked trading perspective, where I'm looking at price patterns, but it sometimes can be helpful even if you're, getting in because of the MACD or whatever. Anyway, so that's how we're going to structure the webinar today. So let's talk about number one. And number one is knowing yourself, okay? So what I want to do here is, let me pull up a chart. About the Aussie Kiwi is a pretty good one. All right, so see this, okay, there we go. Okay, this is the Aussie Kiwi chart. Now, no cheating. What I want you to do, this is number one, which is called Know Yourself, okay? And I'll explain why this is so critical in a moment. But if you could, please type in the chat, or if you're watching the recording, just write down on your computer / phone, iPad, scrap of paper, Band-Aid, whatever you have nearby, just scratch down whether you would be looking, when you see this chart, if you were looking at this chart, now of course this is a historical chart, so we can go back and see what happened, but right now, I'm asking you, would you be more inclined to be looking for a reason to sell this chart, or would you be more inclined to be looking for a reason to buy on this chart? So go ahead and write that down right now, whether it's B for buy, you'd be looking for a reason to buy at some stage, even if it's not right now, just in general. When you see a chart like this, are you looking to buy or are you looking to sell? So just type that in the chat window. B or S. This is number one. We've got to go through quite a bit tonight. There's 6 things on the checklist, so I want to get through all of these as quickly as possible. All right, so they're starting to funnel through right now. And the faster, of course, we get through our list, the more time we'll have for the live charts as well. And it looks like we've got a couple of S's here coming through. Anyone looking for a buy possibility? A reason to buy? All right. So whatever you've decided to write down at this stage, what you need to do is essentially understand that this, and you can do this with many different charts, right? This is important. The reason why this step is so important is because you can often lose your way in trading. And what a lot of people, and the mistake, and so this is the mistake that's associated with number one, is that traders go with um, they go with a good system. So that's mistake number one. And that's not the way that I believe that is the fastest way to success for you. It's not to find a really good trading system. That's not the way. The best way for you to find a trading system is to first look inward and find out what kind of trader you are. If you wrote B when you saw this chart for buy, you're looking for a reason to buy. I'm not saying that you would buy right now. I'm saying that when you see a chart looking like this, you would be looking for a reason to buy, right? In general, just in general. This is just kind of like a litmus test. If you said buy, then you are most likely what we call a reversal trader. You're looking to pinpoint spots on the chart like this little kangaroo tail right here. That's a reversal. Or this double top right here. See how the market hit it here, and then it went down, and then it came back up and hit it again right here. These are where the reversal traders get in. They get in at these spots, right? If instead you said S or sell, you'd be looking for a reason to sell here, then you're essentially going with the trend, right? You're essentially a trend follower or a momentum trader. That's basically what you're looking for. And if you really want to lump them all together, essentially breakout traders are trend traders, but they just get in really early, right? So either you're looking for a reversal here, or you're looking for a continuation of this downward movement, which is basically a trend trader, okay? Now, in this case, what happened is the market sat here and then went lower. So our reversal traders probably either didn't get into a trade, and I don't really see a good reason to get into a trade here in terms of price patterns, naked trading patterns. But if they did get in, they would have been stopped out, most likely. And then the traders who went with the trend would have been fine here. But that's not really the reason. That doesn't really matter, right? What matters is that you identify whether you like to find the turning points or whether you like to go with the flow. And that's critical. So that's the first piece. So number one of our checklist that we're going to build today is determine whether you are reversal or trend trader. Do you look for reversal points on the market on the chart, or do you go with the trend? The mistake here is for people to find a really good trader and just copy what they do. That's the mistake, right? Does everyone understand why that's a mistake? That's a mistake because you are not that person. You don't have those same biases and beliefs about the market. When I first got into trading, my friend was a really, really good trader, but he traded the 1 minute chart. And I thought that was crazy. I thought that was insane. And I kept trying to get us to trade the 4 hour or at least the 1 hour or the daily charts. And so, there was some friction there because we were meant to sort of trade together. And the reason why I couldn't duplicate what he was doing was because, to me, it seemed crazy to sit there in front of the charts and just watch the ticks go by, But for him, it was good fun. So yeah, you really need to identify whether you're a reversal or trend trader, and you don't have to follow somebody who's really good. Really, sometimes what happens is traders find someone who has a sterling track record and millions of dollars under their belt, but that person can't really explain well what he or she is doing. And further, even if he could explain what he or she is doing, you might not make sense of it and it may not work for you because it doesn't fit with your view of the markets. So that's the number one thing. And in the broadest terms, you want to define yourself as a reversal or a trend trader. And Ed is saying, I said no trade. I didn't say buy or sell. Yeah. I guess my question, Ed, was when you see the market go strongly in one direction, are you waiting for a reversal or are you waiting for the market to continue on in that direction? And that's why I try to qualify this, because I know some people are going to say, well, there's no signal there. There's really no signal when you see this pattern. And I would agree. I would actually agree. There is no signal. This is undecided. But I'm just saying in general, if the market's reeling off in one direction, are you the guy sitting there going, oh, this is going to be so good when it turns around? Or are you the guy sitting there saying, oh, I can't wait for this to pause or pull back or do something so that I can jump back in and ride it even further? So that's really what this is all about. So that's number one. Let's move on to number two. Number two, so Ed is a reversal, so there you go. Now, I will say that although you will read in the trading books about how important it is to follow the trend, right? Most of you are going to fall into the reversal camp. I've tested thousands of traders, all right, around the world, and it's very, very common to be reversal, and it's actually a little bit less common to be a trend trader. It's about a 70-30 split. So about 30% of the traders I've tested are trend followers or trend traders, and the other 70 are actually looking for reversals. So that's something to keep in mind. I didn't really want to tell you that because I didn't want to taint your view, but really the important thing is to be honest with yourself and what are you looking for when you see that. All right, let's traders trying to be smart by not following the book. Yeah. All right, cool. Yeah, all right, so let's go. Number two. Number two. Number two is this is what you need to know. And some of you probably are going to know it, but you need to know your numbers. Know your numbers, right? And actually, I think I'm going to go to a different chart here. So this is number two, know your numbers. We'll go over this quickly because you can find all this stuff on the internet. What you want to Google is trading expectancy, okay? Trading expectancy formula or something like that. Really, you need three things. You need to know what your average winner is, which is what this part of the formula is. You need to know what your average loser is, which is what this part of the formula is. And actually, I did this wrong. I mean, just, as a former current, as a math statistics person, I know that should be there. So your average winner, your average loser, and then the win rate, okay? Or probability of a win. So if you know that your average winner is $1,000 and your average loser is $500 or €500 or whatever, 500 pounds, and the probability of you achieving a winner is 70%, then you know everything you need to know here because you can plug in 0.7 here for 70%, 1,000 here for $1,000 winner on average, 0.3 for the probability of a loss, right? And then your average loser, which is 500. So in this case, you would be able to calculate your expectancy. That's what this is. This is the expectancy formula, okay? Now, here's where traders go wrong. They focus on the win rate, all right? And that becomes the be-all, end-all. It is the win rate. Now, I actually think that sometimes it's almost like the pendulum is swinging back the other way, where because we're so aware of the fact that traders tend to focus on the win rate, people are now starting to be savvy enough to understand that they need to focus on the average winner and the average loser. Or another way of saying that is the reward to risk ratio. Because if you know what your average winner is and your average loser is, you can just divide the average winner by the average loser, and that gives you a reward to risk ratio. In this case, it would be 2.0. because we've got 1,000 here, 500 here. So 1,000 divided by 500 is 2. Sometimes people are really, really interested in having such a high reward to risk ratio that they forget this is going to really drag down their probability of a winner, and that can be psychologically damaging to them long term, and they're unable to sustain that trading system. Okay, so that's one mistake. But the other one is sometimes people also, instead of looking at this entire formula here, they start looking at number of trades. And they start thinking, well, yeah, it would be good if I traded this system on the daily, but if I traded on the 1 hour, just think how many more trades I would get. And they start looking at systems in terms of how many trades can I take, how quickly can I build up my account, and that becomes the focus, right? And I think that focusing on the win rate, or focusing on the reward risk ratio, even for that matter, or focusing on the number of trades, just one thing is a mistake. What you really want to do is look at everything together, right? And decide, are you the kind of trader that wants to win a lot? If so, then you need a high number here, right? That's probably going to drag down your reward to risk ratio, right? But if you're the type of trader that just really wants to have a high reward to risk ratio and loves those big fat winners and doesn't mind losing 3 out of 10 times, then maybe you're the kind of trader that we would talk about trading a system that has a 35% win rate and a 65% chance of a loss. So most of your trades are going to be losers, right? So this is the kind of thing that you have to think about. And the other thing is, when you're looking at number of trades, a lot of people think, well, if I can get in 25 trades a week, then I can quit my job in a couple of months, or I can retire, or I can tell my job to go, my boss to go shove it, or whatever. And those really are, you have to keep in mind that just because your system has particular numbers on the daily doesn't mean it'll hold through when you're trading the 15-minute chart. And it probably will be totally different. In most cases, it's easier to achieve a high win rate when you're trading the higher time frames. And when you drop it down, you've got to be really careful of a couple of things. One is burnout. Most traders burn out when they scalp long term. Only the most disciplined traders are able to sustain that, over decades. And so it really, you've got to look at this holistically. So the mistake here is that people often focus just on the win rate, or just the reward to risk ratio, or just on the number of trades. Ed's got a really good comment here, which is, my conclusion for the market is to look at it like a sea of sharks, and the less time spent in there, the less chance of getting eaten. I agree. Another way to look at it, Ed, is that you're the lion. You're the lioness, or the lioness, right? Because lionesses are the ones that do the hunting, I guess. And you're kind of just sitting there behind the tall grass, and you wait, and you wait, and you wait, and then soon enough, easy prey will walk by, and then you pounce. That's how I prefer to look at it. But it's kind of the same thing. In both cases, but basically what we're doing is we're restricting the number of bullets that we fire by using our systems. Yeah, I'm talking about expectancy. That's right. So what will happen when you calculate this deviant is you will get a number, right? And everybody knows what that number means, right? If you calculate it out, you'll know that based on your number, what you're going to get, right? So if your risk, let's say that your expectancy is 2, right? And let's say that your expectancy is 0.5. Okay, you work it out as 0.5. So what that means is, if you're risking $1,000, then you're going to make $500. If you risk $1 million through that trading system, then you expect to make 500,000, and so forth. So it's really just what the system is going to spit out. That's what your expectancy is. Yeah, on average, exactly, on average. So if you're risking $1, you're going to make 50 cents on average using that system. So that's basically expectancy. All right, that's number 2. And then how much win rate is good if you only trade the daily charts? It really depends, Rocky. There isn't really any rule of thumb. What I would encourage you to do is decide for yourself, kind of like deciding if you're a reversal trader or a trend follower. What you need to know is, like, I have a friend who we're actually going to interview him for our members in a few weeks, and he trades with super, super low win rate. But of course, he has just massive winners. And I'm really excited to share his story with, my trading friends because what he does is so unusual. And there are some people, I've actually hooked him up with another trader that I know so that they can kind of bounce ideas off each other, but they both kind of trade in a similar way. And they actually are on the same time zone too, which is kind of cool thing about knowing traders around the world. You get to connect with people and stuff like that. So they're kind of both similar in what they're doing, and so these sorts of things are rare. Most people are going to want to have a high win rate, right? Most people want to have a high win rate. So that's going to drag down your reward to risk ratio. Now we're going to tie it all together in a moment, but right now, just want to go. Number 2 is to know your numbers. All right. Next is number 3. Define your risk. Okay. This is a little bit tricky. Okay. There's 2 ways that you can do this. Again, what you can do now is you can Google this stuff. All right. And what I want you to look at is risk of ruin. This is something that a lot of traders don't look at. So you need to define your risk. What are you scared of? Okay. Most traders, the mistake here's the mistake with number 3. The mistake is most traders don't look at it as defining their risk. Most traders think of how quickly can I get to X number of dollars? How quickly can I quit my job? How long before I make this amount of money, and so forth. That's how they look at this. And so their risk is defined in terms of a goal rather than in terms of, so they look for the positive and they forget to focus on the negative. Well, newsflash, here's why most traders give it up or just get to that breaking point, is because they've risked too much and they've dug themselves into a bit of a bind. So this is what I'm talking about when you say, okay, this is a great question, Alex. Does risking anywhere between 2 and 4% of total amount considered as high risk? And this is exactly why I define this here. Because, and this isn't to pick on anybody here, but Alex, the answer is it depends. And here's why. Most people look at percentage in a vacuum, and they don't look at the interaction between the percentage you're risking and your trading system as defined by the expectancy formula that we just went over in number 2. Let me show you exactly what I'm talking about here. And this is a big deal, guys. So this is definitely a writer downer because most people, when you read a trading book, and this is not anyone's fault here, but how it's presented to you in trading books is that you risk 1% or always risk 2% or blah, 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 blah. Well, I'm here to tell you that's a load of crap, and here's why. So what this table is going to show you, all right, is your win rate for your system. So let's say we've got a 50% win rate system, and then your reward to risk ratio here. Let's say we've got a 2-to-1. So essentially, we risk $1 to make $2. Okay, our average winner is $200, and our average loser is $100 with this system. Let's say. Now, if I'm risking 2% per trade, the probability that I am going to blow up my account and lose all of my money risking 2% per trade, knowing that I'm going to risk $100 to make $200, and the probability of winning is 50%. I have a 0% chance of blowing up my account. Okay? However, as soon as I start taking profit too early, instead of taking $200, I've been burned a few times. The market came back and stopped me out. So instead of waiting for that $200 target, I decide to go ahead and take profit at 180. 175. Oh, it's gone in my direction. It's pulled back quite a bit. I'll take profit at 150. You know, what happens is you are eroding your reward to risk ratio, and you are somewhere between 0% chance of blowing your account and a certainty that you will blow up your account. In other words, what started out as a really safe system to trade, remember, we're risking 2% per trade here, right? This is a 2% per trade. I'm not doing something crazy like trading, 15% of my account on each, risking 15% on each trade. I'm not doing that. I'm just doing the 2% because that's what, uh, Dr. Who said in his book, and when he wrote his trading book that I read, and I thought it was the greatest thing since sliced bread. So I'm doing the 2% thing, right? But the problem is I've had 4 or 5 losers in a row, and the market came really, really close to my profit target, and then came back and stopped me out or hit me at break even. And that's driving me crazy. So I decided to take profit a little bit sooner than that. So I'm turning this 2 to 1 closer to 1 to 1. Now granted, it's not exactly 1 to 1, but what has happened is I don't have a 0% chance anymore. That might be a 33% chance now because I've moved down and my average winner is now $185 instead of $200, right? And this is the danger that people get into because they're focusing on this, right? They're focusing on this number. It's not just this number. It's how this number interacts with your average winner, average loser, and your win rate. So that's really what this is all about, guys. And that's why I wanted to talk about this. This is number 3 on our list, which is defining your risk. So as Deviant also has posted here, a low win rate means that you are going to have high drawdowns. And the reason why, of course, is that you're going to get these 15 losers in a row. That's going to happen. Now, just as I talk about the risk of ruin on that spreadsheet that I just showed you, you can also calculate the likelihood of having 10 losers in a row, 15 losers in a row, 20 losers in a row. And all of those numbers go up. The probability of having 20 losers in a row is almost certain if you've got a 35% win rate. It's a little less likely if you got an 85% win rate, right? So that's basically what Deviant's talking about. Okay, and Ed's got a great question, which is how many losers before you look at a system again in a row? Once you know what your numbers are in terms of defining your risk, the likelihood of ruining your account, which is what we were just talking about, risk of ruin, and the likelihood of a drawdown of X amount, you can calculate both of those. Now, we've done webinars just on that topic. So if you don't know how to do that, I'm sorry. We're not going to get into that today here, but we have done webinars on that and show you exactly how you can do that. But for right now, I just want to, there's 2 ways that you can do it. And you should know when you're looking this stuff up, there's 2 schools of thought. One is the formulaic method, where you plug in your numbers and it spits out a number with a formula that says you have a 15% chance of having 15 losers in a row, right? The other way is to use Monte Carlo data, which is essentially like doing practice runs. And that's kind of my preference to do that because what you can do is you can run your system through its paces, say 15, 20, 1,000, 2,000 if you're a programmer times, and you can see what's likely to happen. Now, it doesn't tell you exactly what's going to happen in the future. It just tells you, okay, if I run it through this 50 times and 25 of those 50 times I have a drawdown of 25%, I should expect to see a drawdown of 25% when I go live, that sort of thing, right? So I believe Monte Carlo data is much, much better than using the formula. But that's my opinion, and there's a big debate, in statistics about that. So I don't want to get too much into that. All right. Cool. Again, there's 2 ways to calculate risk of ruin and risk of a drawdown to a certain amount. Let's go to so remember, the problem here is that people are looking at how quickly can I get to X number of dollars instead of looking at how likely am I to have 20 losers in a row, how likely am I to blow up my account, and so forth. Number 4 is, it's related, and this is to find the likelihood of a maximum drawdown, right? So you need to define your what your maximum drawdown is. So likelihood of max drawdown. And we just talked about how you can find out the likelihood that you're going to ruin your account or blow up your account. You can do the same thing with the drawdown. Again, you can use a formula or you can use Monte Carlo data. And I am a strong believer in using Monte Carlo data. And I've done webinars on how you can use a spreadsheet to just do this and find out what kind of drawdowns to expect by running the numbers over and over and over again, just using random numbers essentially. And the basic reason why it changes is because you never know what kind of sequence of you're going to get. When you first start trading live, you never know if you're going to start out with 5 or 6 losers or if you're going to start out with 15 winners. That kind of stuff changes, and that's why you need to run Monte Carlo data just to see the flow of what's possible. All right. So the problem here with this one is that, again, people are focused when instead of looking at the maximum drawdown, they're focused on how quickly can they get to a certain amount of money. They're looking at the positives and they forget about these negatives, which is it likely I'm going to blow up my account if I trade this way, or is it likely I'm going to hit? A lot of traders, they say, yeah, I can survive a 30% drawdown, but when it actually comes, and your $100,000 is now down to 70, a lot of people start changing things. And this kind of goes to Ed's question, which is how many losers before you look at your system again? If you know the likelihood that you're going to have X number of losers, let's say 10 losers in a row, and you know that you've got a 45% chance of that, then you shouldn't be surprised when it happens, and you shouldn't change your system. I believe that traders are too quick to change their system in general, and if they did these numbers and knew that they had a 45% chance of having 10 losers in a row, over the next 1,000 trades, then they wouldn't be changing their system. They wouldn't be moving to a system that's different from the one that they spent all this time testing. All right, let's keep going here. Let's go to number 5. And this is kind of my secret formula that I share with all my students and traders who are basically serious about trading. This is basically what I say that I suggest. This testing process, you want to treat it like a job. You want to go through a very deliberate way of verifying your system. So once you've done everything else that we've talked about here, what you want to do next is essentially a 3-step process to vet your trading strategy. The first one is to trade in Forex Tester. Right? So Forex Tester. Now, if you don't have Forex Tester, you can certainly get it. I think I've got a link. If you want to get, if you don't have it, you can get it through my link. I think I get, $20 or whatever if you go there. It's also, I think you'll save 30 or 40 or 50 bucks or something like that if you go there and get it. But basically, it's the tool that if you're serious about trading, you need this tool. Okay, you really do need this tool if you're serious about trading. You need to so what you do in Forex Tester is you trade your system as you've defined it, and then you triple it. So number 1 is to take your system's rules using sound money management and actually risking the exact amount that you should risk on each trade, whether it's 2% or 1% or whatever you decided on. You trade your system in Forex Tester and you keep trading it until you triple your account. So triple it. Then number 2, B on our list, is you forward test. Forward test. How do you do that? You get a demo account. And there are demo accounts out there that do not expire. So you can fund a demo account, keep trading it until you triple your account. So now you're doing the exact same thing you did in Forex Tester, where in Forex Tester you're trading historical data. Now that you're forward testing, you're actually trading, the real-time data. So it's going to take a little bit longer, but you still want to triple your account. Cool. Thanks, Deviant. Yeah, Deviant's shared a link for everyone here. You can get the expectancy calculator and losing streak calculator in Excel. It's Monte Carlo. Cool. Awesome. Thanks for that. That's great. The next the third and final step of your testing process is to basically triple in what length of time? It's going to depend, Ed. I actually, one of my favorite people, we had her on for a webinar, and if you go to my website, you'll see it on there. It's a six part webinar, and it's really good. And what she did was she talked about how she tripled her account between December and I think April, her live account. And what's interesting about this was that only a year prior, or less than a year prior, like 9 months prior, she had just lost all of her profits. So she didn't lose money in her trading account, but her trading account was back to where it started, right? Um, and so what she did was she talked about this process of being able to get to the point where she was able to really accelerate her account. Whereas when she first started trading 9 months prior, she made some money, but then she gave it all back, right? And then this time around, she started from December to April, so whatever that is, 4 or 5 months, right? She tripled her account. So I'm not here to tell you it's going to take you, 3 months, 3 years, or 10 years, or whatever. I'm just here to tell you that the mindset that you have is much more important than the trading system. Let me say that another way. We tend to put so much focus on the trading system as if the trading system is doing the work. But we're the ones who are executing the system, and we're also the ones that are sabotaging ourselves. So it's important for you to focus on what's really going on. And that's why my friend Nicola, I think that's why one of the reasons why she really started to see her results take off. And again, you can see her story. It's all free there. Her videos are there at fxjake.com/blog. That's where you can see these. They're up right now, actually. So it's a really good story if you haven't seen it. I know a lot of you have seen it. So I don't know how to answer that question, Ed. I just want to tell you that it is possible, okay? No matter what people tell you on trading forums, and there's a lot of negative energy going around in there. It depends. I mean, some people they test in Forex Tester and they take a $10,000 account to 2 million, and other people they can't double their account until they've tested in Forex Tester for 8 years. I mean, it just depends, right? It's going to depend on your approach. The last thing that I recommend that you do is you actually get a small account. Now, this is sometimes forgotten that traders, you don't have to take all of your risk money and risk it all right when you get into trading. If you've done this process, you've tripled your account in the simulator, and you tripled your account with a demo account, and then you've tripled your little tiny account, which let's say that you've got $50,000 to trade. Well, maybe in your small account, you're actually only going to risk, I don't know, $500, right? And once you get that $500 up to $1,500 or $1,600, then you say, okay, all right, I'm ready to go. And then you go with your live account, all right? So that's really, and again, what the mistake here at step number 5 is that people often don't do any of these. I didn't. They just go straight into trading their live account. They don't trade in Forex Tester, and they don't use a simulator. There are other ones, I'm sure, other than Forex Tester. It's just the one I'm familiar with. They don't. Maybe they do a little bit of demo testing, but they're not as vigilant about it. And so if you go, here's the thing, guys. All the traders I know that are doing really, really well, they've all done this process. Every single one of them. It's almost like I can tell whether or not someone is going to make it to the other side of consistency by whether or not they're serious enough to go through this process. I don't know. I mean, it's up to you. So, and I know some of you are nodding your head here because you've done this and you've gone through this process, and you can talk about how it helped for you. Deviant says it's just about enforcing good habits. Start small and build it up. And Alex says protect before you earn. So it's really, I mean, this is a confidence booster here. People come to me and they say, I've lost my confidence. Doing this, you tell me after you've done this process, if you're gonna where your confidence is gonna be. Of course, I think we all know the answer to that. You have a lot of confidence if you do that. And so the last step here is just to go live. And what I recommend when you go live with your live trading account is to then that the real work starts. You want to work on your mindset. You want to work on your beliefs. You want to uncover what your expectations are, right? And again, there's a whole lot. I built a whole course on this, the trading psychology course called "You Get What You Trade For," and it's all about getting to that point where you uncover these sort of like these blocks, these hurdles in your life, and might be things that you're not even aware of. I know it's hard to get these. Once you get them, then you know how to erase them basically and replace them with better habits. But this is really, these last two steps are sort of like once you can just get through 5 and then now you're into 6, and it's almost like you're always kind of it's like a dam that's ready to break, right? And you're always kind of sticking your finger in the next crack that you find and sealing up that crack, and then another one comes. That's kind of the way I look at this. It's not like you get to number 6 and you can relax. It's actually quite active to be in the final step. It's not something that's passive. Okay, so that's basically it, guys. Hopefully, you have a good checklist here. Ed says a small account you can do it fearless, but when it gets larger, then fear can creep in. So this is really what I'm talking about, Ed, with number 6. So this is one of those things that we would be working on. You know what I mean? Because look, I know some traders that they trade. The concept of money is so different to how it is for most people that the way that they trade, it's like a video game, and they're just kind of racking up points or whatever. And so they don't look at it like, oh, I just made enough money to go and buy a BMW today. They don't look at it that way. That's not how they look at it. They look at it like a game. And so their mindset is very different. It's about following the rules of the game. It's not about trying to make them enough money so that they can send their daughter to college or whatever. It's a different sort of way of approaching it. What about the Sharpe ratio? I think that's totally irrelevant. In fact, I think the trader ratio is much better than the Sharpe ratio. The trader ratio is going to tell you a lot more about whether or not you're going to make it. Do you know what the trader ratio is, Ed? I'll give you what the trader ratio is. Exactly. Alex says 500 might be a huge amount for individual A. Well, the opposite would be. That's why I say a small account. It might be $50, right? It might be 50 pounds or whatever. Yeah, okay. So agreed. Definitely agreed. Okay. So the trader ratio, well, we can talk about that on another webinar. I don't want to get too deep into that. That's what I found to be the best predictor of whether you're going to succeed or not. So this is the process I would recommend. Now let's get into the live trade. So you can go ahead and post your questions here. If you have any questions about anything, the ones I'm looking at are I'm going to be looking to sell the pound Aussie, depending on the close here. So that might be a trade for tomorrow. I believe I have sold yes, I have. I have sold the Canadian dollar at 30.39, stop loss at 31.86. This just happened while we were talking over the last, probably the last 20, 30 minutes. So stop loss is up here, targeting 28 and then 26.50. Actually, it's this trend line here. So this 26.50 target is actually going to move higher as the trade takes longer to get there. It could actually be, probably not going to be much, much lower than 26.50. In fact, quite unlikely. So I'm in on this one, and I'm looking to target 28. I might move to break even if I can get a candle to close below 1.2970. That would be ideal. All right, and I'm also in a trade on the pound yen. I bought down here at 192.25. It's at 193.88, so it looks like it's up 160 pips, and I'm targeting 197 and 202. So that's basically it. I'll probably take the pound Aussie tomorrow. I am in the CAD, and I'm in the pound yen. Got a couple of other ones here that are on watch, but they're not quite ripe enough yet. So that's basically it. Are there any charts that you guys want to have a look at before we close it down for today? Any that you would like to see? Alex says the yen. Uh-huh. Now, this kind of reminds me of the Singapore dollar. I would have liked to have seen, if this ends up being a bearish big shadow here today, I would have liked to have seen this up here at the where we hit it before. Because it's not really there, even if we get a bearish big shadow here, I probably wouldn't take it. And I'll show you why. We recently, just a few days ago, had this thing here on the Singapore dollar, and everyone was very excited about this kangaroo tail here. And I said, you know what? I don't like it. It didn't get to the zone. Ideally, this kangaroo tail would have hit the zone, and the tail would have gone through the zone, and then it comes back and closes below the zone, basically confirming that the market doesn't want to go out there and doesn't want to break higher. So what happened is it broke lower the next day, and we all know that Mondays are absolutely the worst day to get into a daily chart trade, right? Because usually Monday goes one direction, and this Monday it did go down, and the rest of the week the market goes somewhere else. And in this case, it seems to be going up this week. So that kind of reminds me of what's happening on the yen, and that's why I would definitely stay away from the yen, simply because I don't like trading it when it does a near miss like this. I'd be much more comfortable if it was moved up even just another, 30 pips. 20, 30 pips would have been much better situation. So I would stay away from that one. Any other ones? That's it? Cool. All right. Well, I think we're off, guys. Thanks so much for your time. Thanks to those of you watching the recording. I hope you have a wonderful trading week, and we will see you soon. Thanks so much, guys, for spending time here. Hope to see you next time. Thanks, guys. See ya. Thanks, Alex. See you, Deviant. Bye, Adinda. Bye, Ed. Bye, Alex.